Hello and welcome to Alive Credit Union's financial wellness webinar, How to Build Your Credit. My name is Hallie Hagest. I'm one of Alive's certified financial coaches and a certified master practitioner of financial capability. If you haven't heard of Alive yet, we are a not-for-profit financial institution serving Northeast Florida. We prioritize healthy habits, financial wellness, and an easy digital banking experience. Today, we hope to provide you with a comprehensive guide to building credit, whether you're just starting out or repairing your credit after some speed bumps. To begin, we will cover some credit basics. This will be a brief overview, but if you want more details on how credit works, please check out our previous webinar, Demystifying Credit. We will cover building a credit foundation as well as repairing credit. We will discuss meeting goals and cover resources. Building good credit is so important. Think of it as a rewards system. The better your credit, the more financial benefits you get. With a strong credit score, you're more likely to get approved for loans, credit cards, and even rental applications. This means fewer obstacles when trying to finance major life goals. Lenders reward financially responsible borrowers with lower interest rates. This means you'll pay less over time for things like car loans, mortgages, and credit cards. For example, on a 30-year mortgage, even a 1% difference in interest could save you tens of thousands of dollars. Good credit can also allow you to borrow money over a longer period, making your payments more manageable. For instance, an auto loan might offer you a 7-year repayment term instead of just 3, helping lower your monthly payment. Is a measure of your financial responsibility. It's essentially your financial reputation, the way lenders, landlords, and even some employers assess how reliable you are with money. Your credit history is a record of how you've displayed your financial responsibility. Based off of your performance, a credit score is generated. This score can range from 300 to 850 and is based on 5 factors: payment history, amounts owed, length of credit history, new credit, and your credit mix. Think of payment history as your report card for paying bills. It makes up a whopping 35% of your credit score, so this is the most important factor. What does it track? On-time payments, which are great for your score, late or missed payments, which can stay on your report for up to 7 years, bankruptcies, foreclosures, and collections, which are big red flags for lenders. Lenders want to see if you're reliable. If you consistently pay your bills on time, you're golden, but even one missed payment can drop your score significantly. So if you take one thing away from today, it's this: pay your bills on time every time. Pro tip: set up autopay or calendar reminders so you never miss a payment. Next up, we have amounts owed, which makes up 30% of your credit score. This is also called credit utilization, and it's all about how much of your available credit you're using. Low balances are good for your score. Maxed out cards, bad for your score. Lenders want to see that you can manage credit without relying on it too much. A good rule of thumb is keeping your credit card balances below 30% of your credit limit, but if you keep it under 10%, even better. Here's an example. If you have a $1,000 credit limit, try to keep your balance below $300, which is 30%, or under $100, which is 10%, ideally. Pro tip: if you pay off your balance before the statement comes, your reported balance stays low. Length of history makes up 15% of your score and is basically about how long you've been in the credit game. Older accounts equals better for your score. Closing old accounts equals maybe hurting your score. Lenders want to see a track record. Someone with 10 years of responsible credit use looks way more trustworthy than someone with just 6 months of experience. Pro tip: even if you don't use an old credit card, keep it open, as long as it doesn't have an annual fee. This helps maintain your credit age. New credit, 10%, those hard inquiries matter. This one's all about how often you apply for new credit, and it makes up 10% of your score. A few inquiries, no big deal, but applying for lots of new credit all at once is a red flag. When you apply for a credit card or loan, lenders do a hard inquiry on your credit. A couple of these are normal, but too many in a short time can make you look desperate for credit, and that's not a good look. Pro tip, space out credit applications and only apply for new credit when needed. Finally, we have credit mix, which makes up 10% of your score. This one's about having a mix of different credit types because lenders like to see that you can handle different kinds of debt responsibly. A mix of revolving credit, like credit cards, and installment loans, like auto loans, mortgages, student loans, can help. Only having one type of credit might limit your score potential. It shows lenders you can juggle different types of credit responsibly. But don't open new accounts just to prove this. Your payment history and credit utilization matter more. Now that we've covered what makes up a credit score, let's talk about credit reports because that's where all the magic happens. Your credit report is like a financial report card that tells lenders how you've handled credit over time. And we'll also cover the two main types of credit so you know exactly how different credit accounts impact your financial health. So first things first, what is a credit report? A credit report is a detailed record of your credit history. It's not just your credit score. It includes personal information, such as your name, address, and social security number, credit accounts, such as credit cards, loans, mortgages, etc., your payment history on those credit accounts, on-time or late payments, credit inquiries, who has been checking your credit, public records, such as bankruptcies, collections, foreclosures, etc. Lenders use this report to decide whether to approve you for credit and what interest rate to offer. Your credit report typically comes from three major credit bureaus, Equifax, Experian, or TransUnion, and your credit score may vary slightly in between these three bureaus. You're entitled to one free credit report per year from each bureau at annualcreditreport.com. Pro tip, you can pull from one different bureau every 4 months to monitor your credit throughout the year. Or you could use Alive's free credit monitoring tool on your online and mobile banking to monitor it for free month by month. Checking your credit report isn't just a good idea, it's essential. And here's why. You can catch errors on your credit report because mistakes happen. A wrong account or a payment error could hurt your score. You can also spot fraud or even identity theft. If you see accounts that you don't recognize, someone may have stolen your info. You can also understand your financial picture a little bit better. Before applying for a loan, you can check your report and make sure there's no surprises that are going to pop up. Pro tip, if you do find an error, dispute it with the credit bureau ASAP to get it corrected. Now, let's talk about the two main types of credit that you'll see on your report, revolving credit and installment credit. Knowing the difference helps you manage debt wisely. Revolving credit, such as credit cards and lines of credit, is open-ended, meaning you can borrow, pay it off, and borrow again, like a circle. Some examples, again, are credit cards, home equity lines of credit, personal lines of credit. The key feature is that you have a credit limit and you can borrow up to that amount. The payment would be structured so that you have to at least make a minimum payment each month, but carrying a balance often means paying interest. It can impact your credit score because high balances on credit cards increase your credit utilization, which lowers your score. Also, keeping balances low under that 30% threshold will help maintain a strong score. Pro tip, pay off your balance in full each month to avoid interest and build a great payment history, of course. Installment credit is just loans with fixed payments. It's often called closed-ended, meaning you borrow a set amount and pay it back in fixed installments over time. Some examples are auto loans, mortgages, student loans, personal loans. Key features are just borrowing once, making fixed payments, and then the loan eventually closes when it's paid off. Monthly payments are consistent and usually include interest in them. The impact on your credit score is paying on time boosts your score and shows lenders that you're responsible. Paying off a loan lowers your debt, but can slightly drop your score because you now have less active credit. Don't worry about that. Pro tip, having both revolving and installment credit helps your credit mix, which is 10% of your credit score. Starting from zero credit history, the key thing to remember is that to build credit, you must use credit. One of the easiest ways to get started is by becoming an authorized user on a responsible cardholder's account. This allows you to benefit from their good credit habits without needing to qualify on your own. Another option that I like a little better is opening a secured credit card, which requires a refundable deposit that functions like a regular credit card, helping you to establish a payment history. You can also consider a credit builder loan, where the lender holds the loan amount in a savings account while you make small monthly payments, building your credit and savings at the same exact time. The most important takeaway is that building credit takes patience and consistency. Making on-time payments and keeping balances low will set you on the right path forward towards a strong financial future. Life happens. And rebuilding credit after past financial mistakes starts with identifying the issues on your credit report: late payments, collections, charge-offs, or even bankruptcy. Once you know what you're dealing with, the next step is tackling your debt with a strategy that works for you. The debt snowball method focuses on paying off the smallest balances first for quick wins, while the debt avalanche method prioritizes paying off your high interest debts first to save money over time. You might also consider a debt consolidation loan, which allows you to combine multiple debts into a single loan with one monthly payment, often at a lower interest rate. This can simplify repayment and help you stay on track, but it's important to avoid taking on new debt while paying it off. Credit counseling can provide professional guidance, and in some cases, debt settlement may be an option, though it can have long-term credit impacts. The key takeaway is that credit repair takes time and effort. There's no overnight fix, and you should be cautious of scams that promise quick results. With consistent, on-time payments and smart financial decisions, you can rebuild and regain control of your financial future. Rebuilding or improving your credit starts with setting SMART goals: specific, measurable, achievable, relevant, and time-bound, to create a realistic plan for success. Check out our previous webinars to learn more about SMART goals. A strong plan includes knowing where you stand, tracking your progress, and using available resources. Alive Credit Union offers free financial coaching to help you develop a personalized strategy, and tools like Alive's credit monitoring tool and www.annualcreditreport.com allow you to regularly check your credit for errors and improvement. The key to long-term credit health is responsible credit use. Only spend what you can afford to repay. Budget your credit usage to avoid excessive debt, and most importantly, pay your bills on time every time. Credit building is a marathon, not a sprint, and by making smart financial choices now, you'll set yourself up for lasting financial success. Here are a few key takeaways from today's webinar. Healthy credit can greatly impact your life. To build credit, just make slow and smart steps, one foot in front of the other. Responsible credit usage is paramount. Rebuilding credit is difficult, but possible despite your past mistakes. And monitor your credit goals and celebrate those wins. Thank you so much for tuning in today. Remember, your credit union can help you with all of your financial challenges. If you have any questions or are interested in learning more, check out www.alivecu.coop.